In the prevailing scenario, there are many global challenges. US GDP growth is expected to slow down, with the US Fed likely to hike interest rates further to combat sticky inflation. Russia has reduced its supply of natural gas to Europe in recent months, leading to further concerns on economic growth. China is facing stress in its real estate sector, and consequently, growth expectations for the Chinese economy have seen significant downgrades. India appears to be a bright spot amidst these global challenges and is swimming against the tide. India is expected to maintain a 6 to 7% GDP growth over the next few years and be amongst the fastest growing economies in this decade. One prominent beneficiary is electronic exports, which have tripled over the last 4 years and are expected to gain a larger share of global supply chains. The re-emergence of the real estate cycle will likely have ripple effects on a range of sectors. Capacity utilization is above the 10-year average, while free cash flow generation for top companies across various sectors is sufficient to fund prevailing capex requirement. Nifty 50 EPS is expected to more than double from financial year 20 to financial year 24 expected. As per the temperature gauge index, valuations are in fair valuation zone. For incremental investments, we continue to suggest 50% deployment immediately and 50% to be staggered over 3 to 6 months, while being able to accelerate deployment during sharp corrections. We continue to maintain bias towards multi-cap and select mid and small cap strategies across MF or PMS or AIF platforms. Currently, the yield curve is still steep, with a sweet spot between 4 to 5 years of maturity, since the future tightening of the policy to some extent has already been priced in. RBI's focus has been shifted to the withdrawal of accommodation and restoring of a liquidity management framework to address risks from inflation while supporting growth. Yields at the shorter end of the curve may gradually increase due to RBI's gradual normalization of liquidity and policy measures. Yields at longer end of the curve may remain volatile due to government borrowings and global factors. Hence, for fixed income portfolios, we suggest core allocation to 4 to 5 year maturity segment through high credit quality target maturity debt funds, which invest in a combination of GSEC, State Development Loans (SDL) and AAA rated instruments. Tactical allocation to select high yield strategies, MLDs, REITs, InvITs can help enhance the yield on fixed income portfolios. Different asset classes exhibit low correlation to each other in the long term. Delphi ASAP is a rule-based all-weather strategy that benefits from asset class diversification. It is positioned as a superior alternative to traditional fixed income.